I'm going to record.
Yeah, recording.
So I'm going to record this. Let me see if I can get it onto YouTube. So this is.
Are you YouTubing and Facebooking or?
Yeah, I want to see if I can get this onto. Yes, so that's how we usually do it.
Or you can put it onto my Facebook. I don't know, whatever.
Yeah. Bloody hell, I haven't done this for a while. Okay. Let me put it on. Bloody hell, I've got so many YouTube channels, I can't even remember which one to use now. Oh, shit. Okay, hang on a minute.
No, don't play the wrong one, mate.
No, it's all right. You can get it on the wrong YouTube channel. Bloody hell. Man, it's been a while since I've done this shit. Sorry, man. Oh, man. Usually Surinder just handles all of this and I just turn up and make great jokes, but I don't.
Yeah, you're the eye candy.
Hey?
So you're the eye candy.
I'm the eye candy. That's the word I was looking for, right? Yeah. So anyway, we'll go with this one and, see and edit permanently. Oh, what's up this? Come on, man. Okay, I'm going to put it on private for the moment. Go live. Let's see. Hopefully I don't muck this up, Oh, meeting is being live streamed. Okay, right. So I think we're live.
Yep.
Right, so it's Thursday afternoon, 5 p.m. I'm about to get YouTube feedback in a minute. Oh, okay, anyway. Right, so welcome back. I hope you've enjoyed your summer break. Welcome back to your favorite part of the week. Of course. What am I talking about? TPP Thursday afternoon show. What else? Where else would you want to be? It's a bit raining outside, so never mind. Look. Yeah, it is here. Oh, it stopped. Man, it stopped. Obviously, they've listened to you, right? So I didn't know you had windows in your offices. Didn't know you could afford them. So, right, look, enough of the mucking about. We got serious work to do, right? We've been skiving for a while. Or you guys have been skiving. So, look, we're back. I'm not sure it's a good idea coming back to all this chaos that's breaking out, but anyway, we are back for, it's not autumn technically, is it? I'm not sure how this stuff works, but we're back for the rest of 2022. Mr. Heathrow's flying. Anyway, it's all chaos there. Right. So we've had a few interest. There's been a hell of a lot of stuff going on since we last spoke to Akhil. So we've got the man himself on there. No offense, Mitesh. He's not well, actually. So, get better soon. Right. So we've had to bring in the big guns. We've had to bring in Akhil. Got some really great questions. Akhil, as our audience has probably forgotten who you are, do you want to do a quick intro to yourself?
Yeah, no, thank you, Dil. Thank you. So my name's Akhil Mair. I am the owner, the managing director, the firefighter, the guy that helps facilitate mortgages alongside our team at our mortgage broker. So we've been providing mortgage solutions for any type of property in the UK, whether that's residential and commercial, for many years now. We're very successful in what we do, and we help clients all around the country, whether that's England, Scotland, Wales, and Ireland. We can help arrange mortgages and property finance. So we are a team of 8 mortgage brokers. We're all experienced and, more importantly, qualified. We have an office presence here in Bracknell in Berkshire, where clients can come and visit us in person, or we can visit our clients predominantly in London and the home counties. What do we do? So what do we do? We are specialist mortgage brokers, and it's imperative as the landscape is changing on a weekly, if not daily basis at the moment, the viewers, the listeners, the property entrepreneurs, or the gurus, or, people that want to get onto the property ladder are speaking to experienced mortgage brokers in constant conversation to understand the trends if you are an investor, the interest rate changes and what that means to mortgages going forward, the return on investments, the capital appreciations, and just a more of a long look at the mortgage market, present and past as well. You've got to bear in mind, what's happened over the last 1, 2, and 3 decades. So we don't just provide mortgages. We are solution finders. We like to hold our clients' hands if necessary and when they wish to, so we can guide them and build relationships. So our core mortgages and property finance we support in are predominantly residential mortgages, buy-to-let mortgages in a limited company capacity as well, bridging loans, commercial mortgages, and development finance as well. So if anybody that's got any questions relating to any type of mortgage, or even if you are an entrepreneur or you're looking to get onto the ladder, pop your questions onto this live chat, and we'll do our best to answer them. Or as you can see by my name there, our mortgage brokerage website is on there, which is ourmortgagebroker.co.uk. Feel free to send us an inquiry or a contact us link, and we'll do our best to give you a call back to answer any questions. Hope that helps, Dil.
Thank you very much. I was going to say exactly the same, but more importantly, I think both of us play at being amateur economists, right? Well, I think we do better than the real economists, because they don't even know what they're talking about half the time. It's a known fact. and any economist will tell you it's an art, not a science, which means they bugger it up and get it wrong. Probably not allowed to say that, but they get it wrong a lot of the time. So, we love more than pretending. We love our interest in economics. And this is one of the reasons I've got you on this week's show, because I don't know about you. I think there's all chaos breaking out. So I want to discuss a couple of points, and had to get my phone out. I lost the pens and the paper, and haven't got any 50p's.
You're becoming environmentally friendly.
Sorry?
You're becoming environmentally friendly. No papers, no pens.
No, I've got loads of paper around. I just couldn't, the writing skills didn't add up. So I just thought I'd try the phone for a bit. But anyway, so look, Srinder's run off with the £50 notes. We've sent him a message. He's coming back in a minute. In the meantime, I've got a few 50p's. So we're going to carry on with as many 50p's until we run out. Actually, that's an interesting subject. I'm going to come to that in a minute. Right. Okay. So we've had a few interest rate rises since the last time I spoke. I can't even remember where we are. Have you got a clue where we are and where it's all going? What do you think they're going to take this interest rate? I mean, not that there's enough bad news out there already.
Yeah.
Yeah. Where do you feel that the interest rates are going to end up going?
Well, you know what? If we had that, if we had that, that magic wand, or that real answer, we'd all be millionaires by now. But what we can say is we can't predict the future, but we can do our best to try to hedge our bets against what the worst case scenario is. So, for those savvy investors out there, or not so savvy, or not so close to the numbers, now is the right time to start getting close to those numbers, in particularly interest rates, cost of living, and what your mortgages look like in the very near future if they're coming up for renewal. So the Bank of England base rate was at 0.1 for a very, very long time. We haven't had a rate increase for nearly a decade, but we've had about 7 rate increases in the last sort of 8, 9, 10 months. So we've gone from 0.1 to 1.75. And in the likelihood, we're going to have another rate rise in about 2 weeks' time. I believe it's the 15th of September, the next MPC meeting. So I think... Hang
on. You're predicting another rate rise, yeah?
100%. Unfortunately, I hate to be a bearer of bad news, but I think we're certainly going to have not just one more rate increase in 2022. I think there's still going to be a few more coming up, unfortunately. So interest rates are at 1.75. Who knows how high they're going to go? But I certainly think we're going to see at least between 0.5 and 0.75 rate increases in 2022. So I think by Christmas, I think we'll be at 2.5 interest rates. Now, a lot of clients are asking us, what does that mean for our mortgages? Now, let's just put it into context here that if you are, just a few example, if you are tied into a mortgage, so say you've got a buy-to-let mortgage and you're tied into that particular mortgage deal till the 1st of January 2025. Yeah.
Yeah.
Now, what that means to you, the interest rate rises to you don't mean anything in theory, because your mortgage product is fixed, it's tied up till the 1st of January 2025. So between now and then, whether the interest rate goes from 1.75 to 11.75, I hope it doesn't ever do that.
Listen, if it gets to there, we're all dead, mate.
Yeah.
There'll be riots in the streets.
There'll be no comment. I'd love to see what inflation goes to then if it is 11.75. But as we go back to the context, so if you are tied into your mortgage, and let's say in that example till January 2025, it doesn't matter to your mortgage because you are tied in, your payments remain the same, and nothing changes from between now and January 2025. Now, that's not to say to take your foot off the pedal or don't worry about it and cross that bridge when you reach or nearing 2025. You're still going to be very close to the numbers. And what I mean by that is if you are tied into those deals, that's fine. That's great. And you've got nothing to worry about. If you are nearing your end of fixed product rate, i.e. mortgages that are coming up for renewal in 2022 and 2023, you need to contact us. And I'm saying to anybody that's listening or viewing this podcast to contact us, because if you don't action those sooner rather than later, you will be hit. You will then get transferred onto the lender's standard variable rate, which means typically your rate will move to 4, 5, 6% interest rate, where you can avoid it if you look at tying those up and refinancing or doing a product switch with the same lender prior to your deal ending. So in short, if you are tied into your fixed rate, you don't need to worry about the rate changes, but you should keep an eye on when your deals are coming up. Create a calendar note so your phone goes off 6 months in advance, say my mortgage is up, I need to contact Akhil and his team at our mortgage broker. Simple as that. If, for example, you're on a tracker rate mortgage, and that could be a tracker rate on your main residence or a tracker rate on your buy-to-let mortgage, that's going to be pinching you every single month. And that's going to be happening throughout 2022 because of the incremental changes that we've seen in interest rates. So tracker rate mortgages have been negatively affected for those tracker rate holders. And again, for those that are on the standard variable rate. So if you're on a tracker rate, if you're on a variable rate, if your mortgage is coming up for renewal, you need to contact us like today. Where are interest rates going? You know what? I don't know, but I can guarantee my bottom dollar that they're only going one way, and that's up. How high they go, I don't know, but I can certainly anticipate that we've still got to see rate rises, and I think it'll be close to 2.5%, as I said, by December or by the end of Q1 2023. Does that make sense, Dil?
Yeah. I was listening, and it's interesting you talk about this 6 month thing.
Yes.
I think that's a great tip. So they should start talking to you 6 months before
the rate comes up. Yes.
Yeah. And am I right in thinking if someone's on a tracker mortgage, they need to take action? You said now, I would say yesterday, and see if they can get themselves on a fix, because this is a bit weird from what I'm seeing. Mm-hmm. The tracker rates are higher than fixed rates. Is that right?
Tracker rates, it's all over the place at the moment. Some lenders' tracker rates are higher, some are lower. Some 2-year fixed deals are higher than the 5-year fixed deals and vice versa. So, you know what? It's very hard to keep up on all the changes because they're changing so frequently at the moment, which doesn't help the client. It doesn't help with the mortgage journey. It doesn't help us as mortgage advisors as well. Now, there's a reason why clients like to apply for a tracker rate. There's reasons why they apply for the fixed rates. The key here is just to understand what the client's ambitions are, goals are, 1, 2, 3, 5-year plans are, so we can help guide them going forward. Now, if a client wants to purchase a property and wants to hold it for the medium to long term, in theory, that doesn't make any sense for them to apply for a tracker rate, just simply because we know, or we're quite cautious, or rates keep going up on a monthly basis. So if you apply for a tracker rate, then you are going to be penalized each and every month, and it will obviously negatively affect your cash flow. Now, it's not just variable rates, tracker rates, or fixed rates. There's also discounted rates as well. Now, some of the lenders are offering great discount deals, which means it's 5% minus the standard variable rate for that lender. And it can be quite attractive from a short-term perspective. But again, we will speak to the client and provide them with comparison quotes and have that conversation with them. Now, I saw by your hand gesture, the discounted rate. Discounted in an essence, what that means is the lender will offer a rate, let's say a collar rate of 5%, and then the bank or the lender will have their own variable rate, which they'll discount off that fixed rate, of that discounted rate, and then they'll apply that rate then to the mortgage. It's not very common that we see clients applying for it, but just to put it out there, there's not just fixed rate mortgages that are available, albeit that 99% or 95% of our clients do opt to take a fixed rate, just for the sanity and the clearance that they can plan and adjust their income figures and expenditure going forward. So, fixed rates are certainly much more attractive and most commonly applied for.
Oh, okay. That's interesting there. Now, the other thing, and look, I'm guessing what you're saying is you're living in a period of turmoil.
Yes.
Maybe that's not the right word, but period. Fluid occurrences, shall we say, or fluid period, right?
Yeah.
Maybe chaos as well. But it's something that I remember going back to lockdown. We got shut down, but you guys were extra busy. So I'm thinking you've had a practice run for this stuff, right?
Well, you know what? So if we look at, you mentioned right at the top of this call around the economists and what their views were. If we go back to March 2020, right at the beginning of COVID, everyone thought house price crash. Everyone thought, it's the end of the world and so on and so on. But totally the opposite happened, where people were anticipating a crash or a recession even prior to COVID. But what COVID did was made people buy more property. The savvy guys. House prices went up when people thought they were going to go down.
Yep.
The demand went through the roof. And as you quite rightly said, we were one of the fortunate sectors or business sectors that really did well out of COVID from a financial standpoint and from a UK economy standpoint. And the private rental sector for the UK economy is quite a big space in terms of stamp duty revenue as well. Most importantly, inheritance tax, capital gains as well. So it's a massive income generator for the UK from that perspective. But as I said, even the economists got it wrong. They anticipate a price drop. They didn't anticipate anything. Now, I'm no economist. I don't sell myself being that. But what I did suggest about 18 months ago that we're going to see interest rates rising quite rapidly in 2022. And I've got many videos and texts out there that I've said it to many people. Interest rate rises, inflation rises, and unfortunately that is simply because of the amount of money that the UK and actually every single country in the world has printed. Rightly or wrongly, people might say they were too generous about furlough. They were too generous around the stamp duty incentives. It's all hindsight that you can say these things now. But what we can say is the money needs to be recouped. And the best way of recouping money for any government is raising taxes. Now, next Monday, whether it's Truss or Sunak in power, who knows? But they're going to enter a new era of trying to facilitate, more importantly, bringing down inflation and keeping cost of living and housing expenditure, trying to bring it down as most effectively as possible. How they do it, the best way of doing it in combating housing inflation is simply, in my mind, is creating more incentives. You've got the Help to Buy scheme ending in March next year, so they will replace that with something. There's no two ways about that. We've got a shortage of homes out there. We've got rapid rises in house prices. Nationwide mentioned that we've had 10 months on a trot of house price increases. There's still double-digit inflation on house prices. What's your take on house prices, Dil? Up or down?
This year? I think they're gonna the word might be soften, right? And
Yes.
what I mean by that is houses aren't like beans. You can't go into Tesco and buy X number that look the same, right?
Yes.
So the ones that, if you want a house that's done bog standard, there's going to be very little price drop in that. Whereas the ones that are lower down, that are harder to sell. And look, what I've seen in the past 20 years, at least, from when I was a kid,
Yeah.
people no longer want to get a house and do it up. They want to buy the finished product and move in and live there, right? In a sense, they want the lifestyle yesterday. And this is one of the reasons you get Help to Buy, because people don't want to buy the doer-upper and work their way through it. They want it yesterday. Yeah. So there's a sort of reluctance to buy those that aren't that standard. Then again, you had for a long time, you had all the investors that would move into that period, but a lot of those are getting wiser because they're saying, well, the homeowner is willing to overpay because even the ones that are willing to upgrade it over a period of time will see it through because they're looking at a 10-15 year time horizon. Whereas the investors and the flippers are saying, it's not worth it. You're not doing your numbers properly. Yeah, and a lot of the experienced investors are getting wise to that. So it all depends on the standard of your property. The good ones are going to carry on going, maybe don't carry on going up, but they perhaps will take longer to sell. The ones that need work, there's definitely an opportunity. And it's just a case of what guts you've got to demand a discount and whether you keep going until you find the one. And you know, we've had a lot of guests on that say, I'm not buying this, I don't care. Somebody else can buy it. And a lot of people get themselves into trouble. So there's going to be a spectrum. Yes, I think the house prices will soften. A couple of weeks ago, I heard a Halifax thing that said that house prices are going down by 0.1%. And we've got to be careful because the media is all about house prices are going up. Partly because if they say house prices are going down, they probably won't get the funding for the ads, or, you know, and that's something to watch out for.
You know what you know what it is. So the media. Let's just have a quick chat about this media. So, you know, you open one newspaper. I won't mention any names, but you open one newspaper and it's all pro property, pro landlord. You know, house prices are going to keep on booming, and the house prices index are great. You read another paper, another index, and they say prices are coming down, recession's coming in, landlords are this, landlords are that. Now, it depends on, you know, whether you're one of those, you know, half full or half empty types of people, type of person. The other thing I would say is, you know, COVID was certainly a seller's market. And what I mean by that is people are buying over market value. There was a huge crowd outside every viewing, etc., etc. Now, when we, you know, I certainly believe there's a lot of talk out there, when are we going to enter a recession? And my answer is we're already in that recession, to be honest with you. You mentioned that house price bubble. You know, I certainly think we are. I think the balloon is quite not inhaled, it's quite inflated. I don't think it will pop. I think some of the air will come out of that balloon and it will soften. I think that's the word you use. And the reason why I think it will soften rather than pop, and you might disagree with me or agree with me, is simply because August is quite a quiet month for property transactions, even though the statistics still showed quite a high number of stamp duty transactions that occurred in the month of August. But what happens is, because people are starting to return to work and we've had interest rate increases, naturally that will slow down the market. Now, as mortgage brokers, the number of inquiries, and I'm not going to lie, why should I lie? We're still doing very good numbers from an inquiry and a completions perspective, but the numbers have dropped. Now, if I compare that to 20 and 21, of course they're going to drop because the incentives weren't there. It wasn't a seller's market. Now, what's happened now is people are becoming a bit more savvy around, as you mentioned, you know, the offer prices that people are putting in. Not everyone is buying over market value.
Yeah.
And people are questioning whether the property is worth that value. How much money do I need to add into that refurb to bring it up to a good standard, a good value, and in line with the street's profile? So, I think, who cares what I think? But, it can only be right or wrong. There's no third wheel in this. There's no three sides of any coin. So, I certainly think it will soften, and I don't think that's because of people getting nervous of the buy-to-let market. Let's talk about the investor side. I think they're just a bit cautious of where the interest rates are against their return on investments. Now, I had a lender in this morning, and we were joking about only 8-9 months ago where a limited company buy-to-let was on at 2.89. Now, if you ask me what's the rate difference now, we're talking about 4.29. So it's gone up 1.5% in the matter of 7-8 months, which is quite detrimental to anybody's portfolio, whether you're a new entrant or an existing seasoned investor. So, we've been very, very lucky having rates at basically rock bottom. People have made a lot of cash from a cash flow perspective over the last decade. Capital appreciation has done very, very well. And I think we probably do agree here. I think we are going to see a bit of softening, a bit of a slowdown, but certainly the pace is still in the right momentum, and it is an upward trajectory. And the other thing you've got to be conscious of is the number of properties being built. There's supposed to be about 300,000 being built annually, but it's only 200,000. And the costs of building properties, and you're probably better professional to tell me more about it, is the cost of materials has just rocketed over the last 1, 2, and 3 years. So naturally, the slowdown will carry on.
Cost of materials is unbelievable. I was speaking to someone yesterday. Cubic meter of concrete, and I don't believe his figures, but he said it's gone from £85 a meter to 110. That's like a 20%, and that's in the last 3 or 4 months, right? I'm surprised he's getting it for that cheaper price. I think that's still cheap. In terms of materials, it's, I don't know if you remember COVID. There was an enormous shortage of materials. We always get sporadic things where.
Are you talking about the rice and pasta and the?
No, forget the rice and pasta. Don't worry about that. We'll come to that. We'll come to that in a minute, right? I'm talking about building materials.
Yeah.
At the moment, you can't build houses with rice and pasta yet. Okay, or extensions. No. I'm talking about, building materials. You always go through a spate. Well, the multi-finish factories caught fire, so the multi-finish has gone from £4 to £5 a bag to £35 a bag, or something happens with the plaster, or something. There's always something going on recently, right?
Agreed. Yeah.
And then Brexit came along, and you couldn't get materials, and there was all sorts. But the materials are off the. I mean, look, it's almost off the charts now. It's like you can't get the stuff sometimes, and you're thinking there was a development going on during lockdown. They wanted to use trusses. It was in Slough. You know the group I'm talking about here. Instead of using trusses, they had to get because there was a 6-month lead time for the trusses. I think they ended up having to get a carpenter and make the damn roofs with timber, old school, right?
Yeah.
So all of that's got to be factored in. There are projects. I'm also aware of people who've done deals, say a year ago, probate properties, and the guys next door have said, well, mine is worth another 100 grand, and the bloke said, the buyer said, no, it's not worth it. I'm not going to prepare to pay that. But here's something interesting you get. If a property sells at a price that's probably now we can tell is a peak, in their minds, they've got a potential paper gain, right? Unless they're having to sell it, or they think, well, I could sell that and make it up on the other side, pay less on the other side. we get a point saying, well, that's our property's worth that much. Yeah. So you've got to be careful of that. So for example, in that street, the chap had bought one for 630. It was a probate deal. It was really bad news. It needed a lot of work. The neighbor said, well, properties around my street are selling 730. He was next door to him. I'll sell it for 730. The chap who did the 630 deal said, well, it's not worth it. And a year later, he said, materials have gone up. That project's not going to make any...
It's not viable anymore.
Not viable, right? So that's his view. And I remember Jay Howard saying, look, although we think properties are very similar in an area, they have different value for different people. It's really interesting what he came up with. Yeah. So yeah, look, I'm afraid the world is a complex place out there. There's no simple answer.
But you know what? So you know what? So yes, that is 100% correct. But what I would say from that is, there's many positives to take from that, and the most important one is there is so many savvy, property professionals out there that you can rub shoulders with to help you achieve what you need to achieve. And I think it's it's paramount that that we all, if we're unsure, seek relevant advice. So you don't get it wrong, to save time and meet those ambitions and property goals sooner rather than later. So yes, we all know the stresses, the complexities, the pitfalls, the laughter, the joker about our industry, which is fantastic. We all know there's lots of money to be made as a property investor. We know the drawbacks, but one of the lovely say, one door closes, one always opens, and I'm a big believer of that. And yeah, just please, for all the viewers, listeners, take up the relevant advice. Don't be shy to ask someone for a favor in terms of, a question or someone that they can refer you to, because recommendations, experiences, the knows, the hows are so important. And it just saves those, those upsetting times if you get it wrong, because in this industry, if you get it wrong, it can go really badly wrong. Yeah. And that's the last thing you want to do.
Yeah. I was just going to come to a point. This industry is famous for being a shiny penny syndrome.
Yes.
A lot of people get attracted to the money. They're not prepared to learn the hard lessons. And this is one of the reasons we do these programs. There's loads of ads on YouTube about make money this way and X, Y, Z. And I made 30 million quid in 3 seconds by pressing 3 buttons in property. We've all seen that nonsense, right? So look, fortunately, there is a lot of education and content out there. I would say to people, do the hard work, listen to the people, right? Mm. Question for you: where do you think the opportunity is? Okay, so this is a 2-part question. How long do you think the recession is going to last?
Okay, so
I might turn it into 3-part. How long do you think it's going to last? Where do you think the opportunity is going to be? And how do you think we'll know we're coming to an end?
Okay, so how long will it last? How long is a piece of string? I don't know how long it's going to last. I don't think no one knows that answer. But there's ways of combating it, or trying to combat it, or trying to hedge against the worst case scenario. So, going back to what I said previously about interest rates, I always think worst case. If this draws out for the next 5 years and interest rates keep going up, inflation keeps going up, and it's, you can't control it physically, but what you can do is control your household expenses to a certain degree. You can control your rents, you can control the types of assets that you hold, you can control your taxes that you pay. There's ways that you can control different areas that you invest in. So I think now's the time to, one, consolidate, one, to keep looking at your property portfolios to see where there's quick wins. You might have assets that you've owned for a very, very long time that you think are not returning a good investment, that you might want to flog off now because you've still made a huge capital appreciation. I certainly think, if somebody's entering this property game or wants to continue in this property game, I'm a big believer. Property is all about cash flow. Don't worry about capital appreciation. I think cash flow is key in any property investment journey. And yes, I do appreciate if you want to scale, you want to refinance those properties and reinvest, and I get that. And the only way you can refinance is hoping that the property value increases. And how do you increase a value if the market is not appreciating in that manner? Well, the simplest way is, doing necessary refurbs to the property, upgrading the property to a higher standard to achieve higher values. And that's a good way of helping, buying it, refurbing it, refinancing it, and then repeating that whole process in order for you to go up and scale your property journey. So I would say, don't worry about, don't look at the super large picture. Look at how you can control your personal finances as well as your property finances. I think you've got to be conscious of the types of properties that you invest in, particularly those like HMOs. The costs of running a HMO at the moment with energy prices, hitting the roof at the moment and beyond, you've got to be conscious of those costs. Student accommodation, of those costs as well. And I think you've just got to home it in. Those days of 7, 8, 9, 10% yields might somewhat disappear for the short to medium term, is where you're going to recoup that cash into the medium to long term. So I think looking at interest rates and how you're going to fix those mortgages for a longer term will be one of the key drivers from your cash flow perspective. And then also looking at, as I said, the costs of running those properties, predominantly those properties that are very time intensive, that consume a lot of time. So HMO, student accommodation, service accommodation, all that sort of stuff.
So yeah, I can agree with HMOs definitely.
Yeah.
Student stuff, yeah, probably right. Service accommodation, I think it takes a certain type of personality to run that, right?
Yeah.
I know some people who run it, they love it.
Yeah.
I know some people who absolutely hate it. I'm not sure how much you can delegate, and I'm quite London centric, so it's a little bit harder in London, right? So your thoughts on house, that I had a question there, thoughts on house prices for 18 months. I think I've just destroyed that question by saying I don't think there's a typical house. You've got to go a bit more nuance into what sort of house you're looking for.
Yeah, I agree. I think pockets of, there's going to be many pockets, towns, counties of the United Kingdom that'll do very well, and they've done very well. They'll continue to very well. I think, you've just got to bear in mind, where are you investing? What's the demand like? Why is there demand? And can you still see a demand going forward? So, if there's a town that's going to be regenerated in the next 1, 2, 3 years, that'll be a good spot to invest in. If a pocket of England is oversaturated of HMOs, then you might not want to create a HMO there. You've got to look at what's worked, what's oversaturated, and your property's a business. You've got to take a punt, but a calculated punt at times to and when I say punt, I mean a calculated punt, but again, enough to weather a storm. So you've got to have enough money in the safe to weather any storms, whether that's voids, maintenance costs. We talk about values. You don't actually see a value of the property until you sell it. If I had, say, my house is worth 100,000, well, yeah, on paper it's worth 100, but I haven't seen that value come into effect because it's not sold yet, right? So yes, you've got to be conscious of that piece, but as I said, very, very important to see where the saturation is, what markets are trending, and the key one at the moment, and in my eyes, always is cash flow. I
100% agreed on cash flow, because I was listening to a podcast by a US guy, and he made a really interesting observation. He said, properties is an asset, right? And until you're forced to sell it, you won't realize the loss. So you could ride out a recession. And one of the reasons you're forced to sell something is you don't have the cash flow to see your way through. So,
yeah, or you get nervous,
yes,
get nervous.
that was the other point. Well done. That was the other point he made.
And it's very common. You know, if you get nervous, you think the market is going to tank, you sell. But as they always say, you know, entrepreneurs, you know, they thrive on recessions. They love that stuff. And if they see a nervous property landlord, they're probably going to buy it on the cheap. So you sell on a lower end, they buy it for cheap, and then they gain the value on the back end. So you know, again, it's not a game. This game is for professionals, and it has been going that way, especially because of Section 24.
Yeah.
All these legislation changes don't help as well, but you know, sometimes change is good.
Yeah, agreed. Now, you came to a really interesting point about upgrading property, and
yeah,
I'm going to merge it with a question about EPCs. And every time you've done a presentation or Mitish does one, we always hammer in the EPC.
Yes.
Is that new proposed EPC stuff still going through, or are they just what?
So if we just bring it back a tad, so what's EPC? Energy Performance Certificate. What does it mean? Basically, it means if you own an investment property, you're looking for a mortgage, you're looking to let it out, it must have an EPC rating of an E to an A currently. Now, what the government is levying or in negotiations or having a chit-chatter about is basically reducing that bracket from E to A to a C to an A. C for Charlie, A for Apple. Now, what that means is a couple of things. What they're trying to do, sorry, let me take that back. So what they want to do is, or potentially do is, by 2025, any new tenancies that come into effect, the property must have a C to A rating. Any existing tenancies need to have a C to an A. I believe it was 2027 or 2028 or something along those lines. So my belief is this: the market, everyone is feeling the strain because of Brexit, the war, energy prices, interest rates. I don't personally believe the UK government are going to push for all private rental sector properties to be certificated between a C and A, because the cost of doing every single property in the UK, the detriment on cash flows, time, the cost of doing it to those properties will be so negative that it'll actually be a negative factor on the UK property market from that perspective. And you'll have a whole load of properties go on the market that are non-mortgageable for rental purposes, which will mean that they draw the values down. I don't think it'll be C to an A. I think it'll probably be a D, rather C, a D to A. So it'll bring it up one notch to a D to A. I think those people that own properties, you can go onto the EPC register on, if you type into Google, government EPC register, you type in your postcode, you find your door number, and it should have an EPC rating. Otherwise, find your own local EPC assessor to assess your property, to see where you stand. Ideally, you want to be at a space between a C and A. If you've owned property or owned property that was built in the last 10, 20, 30 years, they usually are in good stead. They usually are a C to an A. If you own properties pre-1970s, you know, you might be struggling to get an E, if that, or it might be lower. So the cost of bringing them up to at least an E or D or C are going to be quite costly. So for the property investors, you know, keep an eye on those EPC ratings. They're valid for how many years? Is it 10?
10 years, I believe. Yeah,
they're valid for 10 years at the moment. Double check them. Try to get them C or above. If not, worst case, E. If you've got a mortgage on it, then they've got to be at least, the lender, the solicitor will check that it has got an EPC certificate, a valid certificate, and it is of an E or above rating. But you know, thank you for bringing that up, Dil. It is key that we keep an eye on things like that, because what will happen is the government may change their rules, and if the EPC is not of a certain grade level, you know, it's not going to be mortgageable, and then it'll be another what's that cladding issue? Now it could be the next mortgage.
That stuff's endless. There's cladding, there's polystyrene tiles, there's always something going on, right?
Exactly. So that could be the next mortgage prisoners. So just keep an eye. Listen, with the warning signs are there. You know, everyone wants to become very energy efficient, I'm contemplating buying an electric car now. I don't know what to buy. When should I buy it?
I think you should buy a bicycle, a push cycle. It'll be really good for you.
Yes, that might do. It might help with the old waistline as well, actually. So
Yeah,
right.
mind you, I've seen the e-scooters around. You know, the not the old age scooters, but the new bike scooters.
Yeah, they're very fast. They're very whizzy.
Yeah. They're going to probably ban those and bring some laws in anyway. So a couple of points on the EPC. Look, if you're going to do any works, keep the paperwork, because it's a lot of it's a paperwork exercise. People don't often keep the paperwork. So when they have double glazing done, when they have heating upgrades, boiler, they forget about the paperwork. So put that in your file. That's a tip that I've learned.
I agree.
Yeah, to my detriment sometimes. So look, EPCs don't, that A to C or A to E thing, banding, I believe it doesn't apply to residential stuff, and the guidance for commercial property is different from my understanding.
Yeah, good point. Thank you for raising it. So this E to A, C to A is only for rental properties that are rented out to third parties for investment purposes, nothing to do with your main residence, but they're good. But another you've got to be conscious of, having high efficiency close to A just means it keeps your own costs down as well. So for, as we all know, energy prices are going through the roof. The closer to A, which means that your house is more efficient, which in return means the costs of your gas, electric should be lower.
Yeah. So I asked you a 3-part question about how long the recession is, where the opportunity is.
Yeah.
And what was the third part? I've forgotten now. Sorry. Don't worry.
I can't remember, but
I'll give you my prediction. I think this is going to be a 2-year stint.
Yeah.
The opportunity will be more of, there'll be a great opportunity for people who've got cash and who are going to be cash buyers, right? It's going to be even more pronounced in this recession.
Yeah.
They always have some sort of opportunity in downturns. When's it going to end? I think it's really interesting. If you watch the auction houses, that they I mean, a couple of the auction guys taught me this. They're very fluid in the market, because unfortunately they've started to cheat now. In the old days, everything would go up. It'll be in person. You'd see the market trending, right? But now, because it's online, and we do need to get an auction guy on. I've got a couple of guys in mind. What you see now is, if there's no interest in the lot, they won't even offer it. So they're cheating a little bit. But watch the auction prices. That's a really good market indicator. So 2 years, opportunities probably where people can do deals quickly.
Yeah.
Where are we? 22. I think 23 is going to be a hard year. 24 will start coming out of it. But from recessions I've seen in the past, going in it, people don't realize we're in one. Yes. Coming out, they take too long to realize we're out of it. So just watch that stuff. Sorry?
That was a very good point. And I think, touching on your auction point, auction's a good barometer to look at the forecast, because usually what's trending in an auction is usually what happens in the mass market as well. Yeah. It's usually a 6 to 9 month lag. So that's key. Keeping an eye on the 10-year US swap rates, which have gone from 1% to close to 3% in the last 12 months. That's another key barometer to look at interest rates. What else can we tell? Every day is a changing market. And, where you sit, where I sit in the market, we're quite fortunate that we speak to all types of investors, homeowners, property entrepreneurs, and more importantly, the banks and lenders as well, to see, where their forecast lies, where they forecast things to go, and how they're changing or adapting to the market conditions. So, I'm still very, very positive about the buy-to-let market. I'm asking my clients to be becoming a bit more, number savvy if they're not already, particularly around the costs of running certain types of rental properties, as we said, HMOs and the like. And also, thinking well in advance, keeping your admin up straight, relevant documents, because, lenders are not able to fully satisfy all the underwriting requirements if the applicants haven't got the required document on day one or day two. So, just be smart, get in touch with the relevant people to give you the inside tips, the do's and don'ts, to make sure that the mortgage journey is very less stressful than what it already is.
No. Talking about US and mortgage journey and interest rates.
Yeah.
I remember a program with Mitish, and he said, look, the bridging loans are very close or almost cheaper than the residential mortgage at that time. Yeah.
Yes.
So how is bridging loan market like at the moment? And this goes on back, this connects well with my point about doing on the spot cash deals, because that's a way of financing a quick deal, isn't it?
No, I totally agree. So the bridging market is still very, very busy, very, very lucrative. And it's a great resource for people that are looking to buy property that's not mortgageable, people that want to buy a property refurb and flip, for chain breaks. That's another useful tool. And you can apply for a bridging loan for a month, for 3 months, for 12 months, even 24 months. So it's a great resource to have. Now, with regards, we talked quite a lot about interest rates and the mortgage interest rates going up and up and up. But what we've seen about the bridging market, it's remained static in terms of interest rates, and it's still very, very competitive. So that's great for those people that are looking to still invest in the property market, to do those refurbs, developments, conversions, and take up that type of property finance, because it can be very, very lucrative for those savvy investors to enjoy the comfort and the swiftness of a bridging loan. So that market is still very, very buoyant, still very competitive. And those rates, what we've seen, have not been going this way. They've been going either sideways or downwards. So very, very positive for people that are keen to explore the bridging loan market or continue to explore that market.
So you said something interesting there. I didn't realize this existed, a 24-month bridge.
Yes. So,
how does that compare to a 12-month bridge? Because usually in my mind, you've only got 12-month bridges.
Yeah, so as it says in the tin, it's double the time. Usually most clients take a bridge up to 12 months. Now, this is dependent on the level of works that they need to do to a property, or if they're trying to gain full planning permission, they might want to go over and beyond. Or if their JCT contractor says, the build's going to take 9 months, it's savvy to apply for a 12-month loan, just so they've got that buffer period. They don't incur any, late fees, extension fees, revaluation fees, and the like. Now, if you've got 24 months, usually come into play when you're undergoing a large development scheme. That's where the 24-month the term would apply. And collectively, the monitoring surveyor, the lender, the JCT contractor, the developer themselves, us as brokers, we'll all rack our brains to understand the build scheme or the conversion scheme or the planning scheme, to understand, the true cost or the true term that we should apply for with a buffer period. So bridging loans, typically 1 to 12 months, that's 95% of the business. 12 to 24 months is a very small, but again, an option for those developers that are building out larger schemes.
Okay, that's good to know. And on a 1 to 12 month sort of standard bridge,
yeah,
what's the range of rates and what's the range of deposit we're looking at?
Okay, so a bridging loan could be used for your main residence, which is classed as a regulated bridging loan, or more often than not, it can be used as an unregulated bridging loan for those buy-to-let investment properties, purchases, commercial, semi-commercial properties. With regards to interest rates, between 0.5% to 1% a month, so anything from 6 to 12% per annum is usually the cost. Arrangement fees, typically between 1 and 2% of the loan amount, is typically the arrangement fee. The valuation fee is dependent on the type of security property, the size, the value, the location. And then you've got legal fees to pay as well, to undergo. They're your main headlines around the costs and terms of a bridging loan. Timescales, a quick one about timescales. Bridging loans, you're paying for a premium, you're paying for a premium service, and you're paying for an extra resource to help you bolster your property portfolios or your back pockets. Now, typically a bridge loan can take between 3 days to 40 days to complete. We've completed bridging loans within 7 to 10 working days in the past, but typically 21 days is a good barometer to play against. And for those people that are looking to purchase properties via an auction, typically you have 28 days or 56 days to complete on a bridging loan. And that's where, to complete on a purchase via an auction, that's where a bridging loan will facilitate that purchase within those timescales. Because we as mortgage brokers cannot guarantee a mortgage within 28 days or 56 days. And the last thing you want to incur is late fee penalties or your 10% deposit being lost as well. Yeah, a bit about our bridging loans.
Did you say auctions give you 28 to 56 days? I thought it was 30 days standard.
Yeah, so every you've got to read the legal pack, and that's key when you're looking to bid on a property. Well, definitely before you're looking to bid on a property, you should certainly look through that legal pack, understand all the nuances, and the key here is the completion timescales. 28, 30 days, 56 days, it could be 90 days, it could be anything. But typically what we're seeing in that auction space is 28 days or 56 days on most of the transactions. But the key here is to look through that legal pack with a savvy conveyancer and or somebody else that has that auction experience. But I would say
100%. Don't cheapskate on the legals. Get someone to read it before you.
100%.
Yeah. But they can give you a lot of advice that's worth any money. Just hope Rima's not listening to this. Generally, I don't like lawyers, but that's...
No, we love them. I genuinely do. They serve their purpose like we do. We cannot do without them. They cannot do without us. So, Rima, if you're watching, you're doing a great job. Thank you.
No. Look, Rima's one of the good lawyers. Unfortunately,
she's in litigation, so you're going to be even more careful.
Yeah, my other friends have probably killed me, but they seem to cause more problems than they fix. But the one, not Rima, but the other lawyers, right? I had a really interesting conversation with one a couple of weeks ago. I'll tell you off here. Anyway, so look, if you're thinking of buying auction, money with the lawyers with the suits is definitely worth spent. 100% tip. Otherwise, stay clear of them. No, sorry, I can't say. Okay. We touched on investors and limited company rates. Are they still using limited companies, or is that sort of calmed down a bit? What's the?
So there's a lot of so there's about 40 odd buy-to-let lenders in the market, of which half of them, or just over half, now are in that limited company space as well, all with their own bespoke criteria, how many properties that they can allow for in the existing client's portfolio and all that stuff. Yes, it is still quite a big arena in our inquiries and our completions. It's certainly something that people should consider because of the Section 24 tax changes that came into effect sort of 4 or 5 years ago. People shouldn't discount it, but they should take up relevant tax advice. The distinct difference between a personal name buy-to-let and a limited company buy-to-let mortgage is quite simply the interest rate difference. It's roughly between 1% and 2% difference in the interest rate between personal name and limited company. If you're purchasing a limited company, you're just going to be conscious of the additional fees. The most important one is the cost of the mortgage, but then you've got accountancy fees, you've got tax advisory fees as well. So it's one of those that, we always like to provide our clients with two options, one being personal name, one being limited, and then they can go away, compare apples and apples and take up the relevant advice. But going back to your question, yes, it is still a big space. It's a growing market, hence why more lenders are entering the limited company capacity. So yeah, no, it's certainly a big spot for us.
Right, and look, we've had a really great in-depth conversation. Final question for you. Is there anything else that your firm does that you think would be interest to our audience in terms of property investors?
Yeah, no, thank you for asking that question. So, you know, we bang on a lot about mortgages, bridging loans, this, that, and that, all about financing, borrowing. Now, the other thing you've got to be key of, you know, take care of and be conscious of is protection. You know, what type of protection, and I mean life cover protection, critical illness protection. What planning have you got in place for the unfortunate time when the breadwinner, you know, passes away, or when things are not at such a good place? So we offer advice and solution finding for people that want to insure their personal lives. While they're alive, they can get income protection, critical illness cover. So if they're diagnosed with any conditions that are severe, there's various types of insurance and protection policies out there that people should certainly consider if they have not. And we advise all our clients to at least have life cover on the basis that when they pass away in the future, there is certain amount of level of cover that their family and loved ones can receive because of obviously the breadwinner passing away or whatever it be. So life cover is big. Also, we recommend and refer to our trusted partners for wills, lasting power of attorneys, and trusts as well. There's no point building up a large portfolio if you haven't got wills and trusts in place. You haven't got lasting power of attorneys in place, simply because, you know, if you can become incapacitated, you can't read, you can't write, you know, for whatever reason, you've got someone that is dependent that can take on your role, your responsibility in your replacement. So these sort of things that people forget about, to be honest with you, and more people do than don't. So it's key that the viewers, listeners out there, if you are not protected, you haven't got any level of life cover in place, you haven't created a will, you haven't created a trust, you know, you are very, very open to losing a lot of money in the back door. Your loved ones will have to apply through the courts for probate, which can take weeks, months, and years.
Yes, yeah.
More so, the larger the portfolio, the larger the complexity of the asset, can take months and years. We've seen that from time to time. And you know, if unfortunately, you know, the loved one's gone, it's too late. So you know, I know we don't like to talk about these things, but it's key to plan for the future. Don't just plan for interest rate hedging, plan for the inevitable, because yes, it is an aging population. People are dying a lot later, which is good. But you know, everyone has to go one day. So you know, if you are listening, you haven't got a will, you haven't got a trust, you haven't got an LPA, which is a lasting power of attorney, you haven't got life cover, you haven't got critical illness cover, give us a call, contact us through our website, get in touch with us, and we'll certainly advise you where we can, provide you with solutions, or refer you to our relevant business partners.
Excellent advice. Now, just touching on that point, incapacitated excludes Friday and Saturday nights, I'm assuming.
Well, it depends. I'm not going to go into it. It depends how incapacitated you are, but hopefully you don't get to that level that you don't forget what happened the night before. But no, on all seriousness, you know, it's you know, we do this, you know, as investors, as entrepreneurs. We're building this to create a legacy that we can pass down to our loved ones, and we want to safeguard it in the best appropriate manner that we can. So why not, you know, take up the relevant advice, spare that 1 hour, 20 minutes, 2 hours, 3 hours with the relevant advisors to make sure that you hedge against anything negative that could happen. Yeah,
no, good tip. And if you're watching this on YouTube, subscribe and like, and watch some of our previous programs that we've had experts on this. So Akhil, yes. Really interesting chat. Thank you for your time. Really appreciate the second most valuable currency in the universe. and your knowledge, because look, everybody thinks that you know, like you said, we see elements of the market that people don't see.
Yeah.
especially you in your profession, in your company, you've got a lot of knowledge and experience. You've seen how it works. You see a lot of cases. You see a lot of stuff going on.
Yes.
And I think people don't always appreciate that. So it's really good of you to give up your time and come on the show.
I appreciate it. I appreciate it, Joe. Thank you. We're friends on the camera and off the camera as well. But it's key that in any time, good time and bad time, we share any knowledge that we have. And I think I said it right at the beginning. Don't be afraid to ask questions. Don't be afraid to ask for advice, because you don't know what's going to happen tomorrow, and it's better to ask up front than get it wrong and then ask for advice on the back end. And more importantly, every day is a school day as well. We don't know all the answers, but we're very close to knowing the answers, and being that we know people that are very close to the answer.
I don't think at this moment in the UK nobody knows. I don't think anybody knows the answers. It's all going pear-shaped, mate. It's all going Pete Tong, as they used to say.
Yes.
Fantastic. We will be calling you in on a regular basis from what I see is going to happen shortly. So thank you for your time.
Absolute pleasure, Dale. Thank you again. And any questions, feel free to contact us at ourmortgagebroker.co.uk.
Brilliant. OMB, that's nearly like OMG, right? You nearly nabbed that one. OMG would have been great, right?
Yeah, just what does the G stand for?
I don't know. I haven't worked